All right, good evening, everyone. You're welcome to our financial reporting class. Please, someone should confirm you can hear me, maybe my host or from the chat room, please. Okay, just confirm you can hear me. Good evening. Please confirm you can hear me before we start, please. Okay, thank you. Thank you for the confirmation. You are welcome once again. Last time we met, we talked about IAS36, impairment of assets, and IFRS 5, assets classified as held for sale and discontinued operations. And if you can remember, we said an asset is impaired when the current amount exceeds its recoverable amount. So when I have the book value higher than the recoverable amount, then I said the asset has suffered impairment. And of course, your current amount is gotten by looking at the cost of the asset, and then you remove accumulated depreciation, right? So what you have left is the carrying amount. Then once the book value, otherwise known as the carrying amount, exceeds the recoverable amount, then you say the asset has suffered impairment. Now, how do you compute your what's it called, recoverable amount? It's computed as the higher of fair value, less cost to sell, and value in use. So whenever there is an impairment loss, which is the difference between the current amount and the recoverable amount, take it straight to profit or loss account. Okay, take it straight to profit or loss account, except there is a balance in the OCI where the impairment loss will first be taken to the OCI before the balance is now taken to profit or loss account. Then we also take a look at cash generating units, which are smallest identifiable group of assets that generate cash inflows that are largely independent of other assets, right? And we said for a CGU, when a CGU is impaired, then you have to follow 3 procedures. Number 1, you impair obviously impaired assets. 2, you reduce goodwill to 0. And 3, you allocate impairment loss balance to other assets on a pro rata basis. Okay, so that's what you're doing around there. Then from there, you take a look at IFRS 5. It said an asset can be classified as held for sale. Its kind of amount recovered through sale rather than continuing use. And we said for you to classify an asset as held for sale, 2 basic conditions has to be met. 1, the asset is available for immediate sale in its present condition, and the sale must be highly probable. For that to be the case, there are 5 conditions that must be met. Number 1, appropriate level of management must be committed to a plan to sell the asset. An active program to locate a buyer must have been initiated. The price offered for the asset must be reasonable, in line with its fair value. Sale is expected to occur within the next 1 year, and there is no plan to withdraw the asset from being sold, right? So those are the conditions that must be met before you can class an asset or classify an asset as held for sale. And the measurement criteria is assets held for sale are carried or are measured at the lower of their account amount and fair value less cost to sell. So you need to take note of that. So if the current amount is 500 and the fair value less cost to sell is 600, that means you continue to carry it at 500 because that's the lower, right? But if the current amount is 500 and the fair value less cost to sell is 400, that means you write it down to 400. So you have reduced the asset by 100, then you take it straight to profit or loss account, and that is impairment loss, right? That's impairment loss. Then from there, we took a look at discontinued operations. We said that is a component of an entity that has either been disposed of. Okay, the component of an entity that has either been disposed of or is classified as held for sale. So the condition or the recognition criteria is the same with asset held for sale. But the measurement of a discontinued operation is that you must show the total or sum of the post-tax profit or loss of the discontinued operations and the post-tax gain recognized on the post-tax gain or loss recognized on the measurement of fair value less cost to sell must be presented as a single amount in the statement of profit or loss account. So you need to also, understand that. Okay, so I think that is where we stopped the last time. So today, we're going to look at IAS10 very quickly in the next 15 to 20 minutes. We should be done. So I'll just try to find a way to summarize the standard so that we can really understand. Okay. All right, sorry, hold on 1 second, please. Okay, sorry about that. I'm just trying to address some technical issues there. All right, so you permit me to go to the boardroom so that I can demonstrate IAS10. So I don't like looking at those notes. So I can really express myself and give you a better understanding. Okay. All right. So thank you so much for joining, and let's see what we can cover tonight. Okay. So let me see if I can do some. All right. Okay. So we have okay. Hold on. Let me do this. Sorry. I don't think I need to rule cost of what I needed to do. Okay. All right. So I don't think I need to rule. Let me. Sorry. All right. Okay. So we have IAS10. All right. Event after the reporting period. So I need you to be with me here. All right. Now I'm going to use an accounting year. So let's say January 1st, 2021 to December 31, 2021. Okay. So obviously this is a financial year. All right. We also call it accounting year. It can also be October 1st, 2020 to September 30th, 2021. So that's an accounting year. It can be 1st April 2020 to March 31st, 2021. So depending on what the examiner gives to you, but obviously from ICANN questions are always January to December. So this is an accounting year. So you need to understand that. Okay. Then you have something that we call authorization date, right? Authorization date. Okay. Authorization date. What is authorization date? That is the date financial statements are authorized for issue. Okay. The date financial statements are authorized for issue. That normally happens in a public company. So the day they release the account, for a particular period or year for the public to consume, right? Now, in practice, authorization date is usually 3 months after the reporting period, right? So if my reporting period or my accounting year is January 1, 2021 to December 31, 2021, so obviously my authorization date will be March 31, 2022. Okay. So because it's going to be 3 months after the reporting period. Okay. Meanwhile, in your exam, you have to follow whatever the examiner has told you. Because in the exam, you can use 5 months, you can use 6 months. It doesn't really matter. But for the purpose of this lecture, I'm using 3 months after the reporting period. Okay, now this is now the issue here. After the account has been prepared, okay, so between these dates, the account has already been prepared. The account has been prepared, but between these dates and these dates, we have January, and we have February 2022. Okay, so we have January, February, and March 2022. Okay, now some events now happened. Okay, some events happened between that day, but before financial statements are authorized for issue. That is what they call events after the reporting period. So what is event after the reporting period? There are those events, favorable and unfavorable. It's okay, they can no longer hear me. Please, somebody should confirm you can hear me, please. Or is it from my side, or maybe from your side, maybe a call came in or something on the device you are using? So somebody should please confirm you can hear me. Please. Okay, they can hear me. Oh, they can hear me. So that means it has to be from your side. All right. Okay, it has to be from your side. Maybe you might need to, restart your device. Sorry. Okay, so the issue now is, now between the end of the reporting date, which is December 31, 2021 in this scenario, but before financial statements are authorized for issue, that is event after the reporting period. Be with me here. If the event happened during the accounting year, that is not IAS10. That means it happens between January and December. Anything that happens is not IAS10, okay? Anything that happens after the account has been issued out, it is not IAS10. It has to be between the end of the reporting period, but before financial statements are authorized for issue, okay? So according to IAS10, events after the reporting period are those events, both favorable and unfavorable, that occur between the end of the reporting date, but before financial statements are authorized for issue. I could have written it for you, but obviously you're going to waste a lot of time, but it's in your notes, okay? So go and pick it up from there and put it in your head, because this is financial reporting, not corporate reporting. If it is corporate reporting, obviously the examiner will not ask them what is event after the reporting period. But at this level, the examiner can ask you, what is event after the reporting period? Or he says something like, there is usually a lead time between the end of the reporting period, but before financial statements are authorized for issue. You now say, identify the lead time. That is event after the reporting period. So that's what you tell the examiner. There are those events, both favorable and unfavorable, that occur between the end of the reporting date, but before financial statements are authorized for issue. According to IAS10, we have 2 types of events. Number 1, adjusting events, okay? Adjusting events, and non-adjusting events. Non-adjusting events, okay? So we have 2 types of events. According to IAS10, we have 2 types of events, adjusting events and non-adjusting events. You need to listen to me now, because you must understand these 2 events clearly, because both of them occur after the end of the reporting date, but before financial statements are authorized for issue. So how do I know which one is adjusting event and which one is a non-adjusting event? According to IAS10, adjusting events are those events, sorry, I'm looking for my pen. Adjusting events are those events that provide further evidence of conditions. They provide further evidence of condition, okay? They provide further evidence of conditions. They provide further evidence of conditions, all right, that existed at the balance sheet date, okay? at the balance sheet date, at the date of statement of financial position. All right. So they provide further evidence of condition that existed at the balance sheet date. Okay. All right. So they provide further evidence of condition that existed at the balance sheet date. That is adjusting event. So I'm going to give an example here so that you can understand better. Okay. What is that saying? So let me try to do that. So let's say at the year end, remember we are looking at this date, December 31st, 2021. We have prepared the account. Okay. So when we prepare the account, we recognize receivables. Okay. We recognize receivables of, let's say, 100 million in the account. Okay. So as at the year end, we recognize receivable of 100 million. We recognize receivable of 100 million as at the year end. Okay. So what now happens? After the year end. Then after the year end, so let's say around January, okay, let's say around January or February, we now receive information that one of our debtors, one of our customers that is owing us has been declared bankrupt, all right? He has been declared bankrupt. That means maybe out of this 100 million, the guy is owing us, let's say, 20 million, maybe customer A, the summation of 100 million is about 2, 3, 4, 5, 6, 7, 5, 10, customers, okay? Sorry? Sorry, please. Okay. Now, so maybe it's just one of the customer that was owing 20 million out of the 10 million. So we now receive information that this guy has been declared bankruptcy, right? So what does that mean? That 20 million existed at the balance sheet date. Now listen, that 20 million was already recognized at the balance sheet date. Then in January, we now receive information that this guy can no longer pay the 20 million. So when we receive that information, we need to determine when did the guy has the inability not to pay, okay? When did they have the inability not to pay? If it is as of December 31, 2021, then that is an adjusting event. Why? Because it provides evidence of conditions that existed at the balance sheet date. So it means the inability of the customer to pay already existed at the balance sheet date. And him owing us also was also recognized at the year end. So as such, that is an adjusting event. So what do you do? To an adjusting event, it will require that figures in the financial statement, all right? Figures in the financial statement will be adjusted for, okay? Figures in the financial statement you have to be adjusted for. So that's why they call it adjusting event. So statement will be adjusted for. So receipt of information about bankruptcy of a customer is a classical example of an adjusting event. After the year end, let's say around March, we now discover, but before we authorize the account, we now discover fraud that was perpetrated as at December or maybe around November in the previous year. And we did not know. As at the time we are preparing the account, we discovered the fraud in March. So the question is this: is that an adjusting event? The answer is absolutely yes, because that fraud occurred as at the year end. It provides further evidence of condition that existed at the year end, okay? And is affecting the account. IAS10 now says we are going to go back to that account and adjust the account, okay? So that's what it's saying. Let me give you another example, and it will now take me into explaining non-adjusting event. So let's say in January, the following year, listen to me and be with me here. In January, the following year, okay, there was a fire outbreak, fire occurred, and it destroyed one of our property, okay? Fire occurred in January and it destroyed one of our property. So the question now is this, and meanwhile, as at the year end, okay, let me do this. As at the year end, the value of the property is 200 million, okay? Nothing happened to the property as at the year end. The property was intact, but in January, fire occurred and it destroyed the property, okay? It destroyed the property. The question is this, is that an adjusting event or non-adjusting event? This is the answer. You don't need to rack your brain, right? So let me just tell you straight up. This is the answer. It is a non-adjusting event, okay? It is a non-adjusting event because the fire did not occur at the year end. The value of the property was still intact as at the year end in the statement of financial position. The fire did not occur on December 31. It occurred in January. And that's why IAS10 says for a non-adjusting event, they are indicative of conditions. Did you see that? They are indicative of conditions that arose. Did you see? That arose after the year end. That arose after the year end. That means they did not exist at the balance sheet date. They arose after the year end. Fire got a property in February, all right? The value of the property was 200 million as of December. So it is a non-adjusting event. After the year end, there was a major disposal, okay? There was a major disposal of subsidiary. That disposal did not occur at the year end, all right? So that means it is a non-adjusting event. But the entity decides to sell major assets. They are indicative of conditions that arose after the year end. They did not exist at the balance sheet date. And as such, if you have a non-adjusting event, what is the accounting treatment in the account? It only requires a disclosure. According to IAS10, it only requires a disclosure, okay? You don't need to make any adjustment to the account, okay? Because they are indicative of conditions that arose after the year end, okay? They are indicative of conditions that arose after the year end. They are indicative of conditions, sorry. Okay, so they are indicative of conditions that arose after the year end. And as such, it will only require a disclosure. IAS10 now says, when making disclosure, you are going to tell the users of financial statement nature of the event, okay? What happened? For example, it is fire, all right? So you disclose the nature of the event and the estimate of the financial effects of that event, estimate of financial effect, right? Estimate of financial effect of the event, estimate of the financial effect, estimate of the financial effect of that event. So that's what you are doing. Is that okay? You need to understand that. IAS10, there are events both favorable and unfavorable that occur between the end of the reporting date, but before financial statements are authorized for issue. And we have two types of events, adjusting events and non-adjusting events. Adjusting events provides further evidence of condition that existed at the balance sheet date. The non-adjusting events are indicative of condition that arose after the year. For an adjusting event, it will require that the figures in the financial statement be adjusted for, whereas for a non-adjusting event, it only requires disclosure. And in doing that, you have to disclose the nature of the event and the estimate of the financial effect of that particular event. So that's what the standard is saying. Now, be with me here. I think I needed to tell you three more things on IAS10. Then we can look at questions and we move straight away to IAS37. Provisions, contingent liabilities, and contingent assets. If time permits us, I'll beep you on IAS20, accounting for government grants and disclosure of government assistance. Now, three more things to learn. Now, listen, if a non-adjusting event, listen to me, if a non-adjusting event, it is a non-adjusting event, actually, it is a non-adjusting event, but it will impact on the going concern of an entity, all right? If a non-adjusting event will impact on the going concern of an entity, What is going concern of an entity? Ability of a company to exist into a foreseeable future. That is going concern. Then something happened, even though it is a non-adjusting event, but it will have impact on the going concern. They may not be able to continue in business. IAS10 now says that non-adjusting event should be treated as an adjusting event, okay? If it will impact going concern, all right? If it will impact going concern. So you need to take note of that in case the examiner should pick you up on that. So if it will impact on the going concern, then it has to be treated as an what's it called? Adjusting event. Okay, it has to be treated as an adjusting event. So that's the first thing you need to learn out of 3 that I wanted to tell you. Then number 2, problems with IAS10. Okay, what are the problems with IAS10? What are the problems with IAS10? All right. Number 1, window dressing. All right. Window dressing. That's the first problem with IAS10. What is window dressing? Window dressing is a technique employed by management to manipulate reported accounts. Okay. For example, deliberate overstatement of assets. All right. Deliberate understatement of liability. Is that okay? So, and it's a criminal offense and it is unethical. That is window dressing. So if IAS10 is not applied properly, it can lead to window dressing. For example, towards the year end, you can decide to recognize certain transactions so that after the year end, you can now start to reverse. For example, you can start issuing invoices to customers when they have not placed order. Okay, that's what they call channel stuffing. It's part of a window dressing technique. You were raising orders, you were raising invoices. And because of accrual base of accounting, you go ahead and recognize revenue, and then you also recognize receivable. Then what happens to your profit? It goes up, okay, towards the year end. Then at the after the year end, around January or February, you now reverse those transactions. So when you reverse it, it will affect the last year's account, okay? And that is window dressing. So if IAS10 is not applied properly, it could lead to window dressing. Then number 2, another problem with IAS10 is which one is window dressing and which one which one is window dressing and which one is which one is adjusting event and which one is non-adjusting event. So sometimes in practice, it could be difficult to identify which one is adjusting event and which one is non-adjusting event, okay? So that's another problem around IAS10. So if the examiner should pick you up, which I'm not really sure it's going to do, but what you tell the examiner is the problem is that it can lead to window dressing and difficulty in determining events that are adjusting events and non-adjusting events, okay? Now, the last one you now need to learn is dividend, okay? Is dividend. So you know dividend, Rabi, the money that goes to shareholders, all right, as a result of their investment, dividend, all right? So what happens to dividend when it comes to IAS10? The question is this: if dividend is declared before the year end and paid after the year end, is there an adjusting event? The answer is no. It is a non-adjusting event. Dividends are accounted for on a cash basis, okay? So that means you don't need to go and record in liability as at year end. If dividend is declared after the year end and also paid after the year end, it doesn't affect the account, okay? They are accounted for on a cash basis. So that is it. That's what you need to learn. So it is not an adjusting event. It is a non-adjusting event because they are accounted for on a cash basis. Okay, so that's it. So that's the end of IAS10. So let's look at the question to demonstrate our understanding so that we can move away right in time. So let me try to go back to our slide and see whether we can pick a question. Okay, so let me see. You have a question there. The solution is there. I think that one is straightforward. Okay, I think I'm interested in this one. Okay, so now look at this question. A part of the question. Now it says there is usually a lead time. There is usually a lead time between the end of the entity's accounting year and when financial statements are approved and signed off by the directors. In between this period, there are two types of events according to IAS10, which may require consideration when preparing financial statements. You are required to identify and explain this event and state how they are treated in the financial statement. Did you see that? 3-in-1 question. Identify, explain, and state how they are treated in the financial statement. So this is I can pass question. What do you tell the examiner? You identify adjusting events and non-adjusting events. You will now explain. Adjusting events are those events that provide further evidence of conditions that existed at the balance sheet date. Then give example. For example, the receipt of information about the bankruptcy of a customer, discovery of fraud or error after the year end, sale of inventory below their net realizable value. Okay, so you give those examples. Then how is it treated in the account? For an adjusting event, it will require that figures in the financial statement should be adjusted for. Then you have your full marks. Then you go to non-adjusting events by telling the examiner that they are indicative of conditions that arose after the year. For example, fire, outbreak on an asset. 2, sale of major assets. 3, disposal of a major subsidiary. So now you tell the examiner, how is it treated? A non-adjusting event requires a disclosure in the account, and when you're making that disclosure, you tell the user of the financial statement the nature of the event and the estimate of the financial effect of that event. Then you earn your full marks. So that's what you're doing. So when you are looking at requirements, make sure you address every part of the requirement, okay? And you don't just rush and say adjusting and non-adjusting, and you move on and you think you have actually, answer the question, okay? So that's it. Then B part of the question. Company A is indebted to Company B to the tune of 50 million. The financial year end of Company B is 30th June 2014. On 30th July 2014, Company B received the letter from a liquidator advising that Company A has gone bankruptcy. Did you see that? So Company A is owing Company B 50 million, and financial year end is 30th June. I normally say something in financial reporting. Date is very important because you needed those variables, to tackle whatever question the examiner has given you. So the accounting year is June 30th. That means the beginning of that accounting year would have been, is that 1st August? Abi? Yeah. Abi, is that July? Okay. Yeah. So it would have been June, right? Okay. Now, it now said on 30th July 2014, Company B received a letter from a liquidator advising that Company A has gone into insolvency. So most likely, we won't be able to pay the 50 million. The letter review that Company A ceased operation a month ago. We received the letter on 30th July, which is an event after the reporting period. And we're told that this guy went into liquidation a month ago, and that month ago was the year end, all right? So the inability of this guy to pay already existed at the balance sheet date, and as such, that is an adjusting event. Now said, and that Company B is only likely to receive a liquidation dividend of 20 kobo. What does that mean? It means that out of the 50 million, this guy can pay 20 kobo of that of every naira. So all you need to do is to convert it back to naira by saying 20 divided by 100 multiplied by 50. Then you get 10 million. So that guy can pay 10 million out of 50 million. Then 40 million is the balance that he cannot pay. Then you now go to that account to adjust by writing off that receivable. Okay. So now saying it is the normal practice of Company B's board to approve audited account 3 months after the year end. So when you look at that, if June is the year end, 3 months will be July, August, September, and this event happened in July. So it is between the end of the reporting period, but before financial statements are authorized for issue. Okay. Okay. So that's it. That's it. So that's it. Okay. So that's what happens there. Now said, explain how the above transaction should be treated in the account. I have already explained that. It is an adjusting event, and as such, it has to be adjusted for in the account. Then you tell the examiner why it is an adjusting event. because it provides further evidence of condition that existed at the balance sheet date. That's the inability of this guy to pay. You now say prepare journal entry that are required to adjust. So even if you don't know the answer to that first part, then saying this to prepare journal entry, then automatically you should know that that's an adjusting event. So what do? You now debit what's it called? Bad debt. So that's a profit or loss to reduce your profit, because you already recognize that revenue, 50 million in revenue. Then you take it to receivable. Then now go and credit your receivable with that 40 million. Okay, so that's it. Now look at part 3. It says, state what would have been the treatment in the financial statement. Listen, assuming it was fire that destroys company's B's factory on 30th July. Did you see that? What would have been the treatment? Assuming it was fire that destroyed company's B's factory in July 30th, on July 30th, did you see? On July 30th. So what would have been? That is a non-adjusting event because it arose, it's indicative of conditions that arose after the year end. So what does that mean? It only requires disclosure in the account, and that means you are going to disclose the nature of the event, which is fire, and estimate of the financial effect if it is determinable. Okay, if it is determinable. Okay, so that's it. That's it. So that's what you are doing there, and that's it. The C part of the question was talking about dividend. I have told you once it relates to IAS10, and the question is on dividend, forget whatever the examiner is painting in those scenarios. Just tell the examiner that dividend is a non-adjusting event and they are accounted for on a cash basis. Okay, they are accounted for on a cash basis. So that's what you tell the examiner. And that will take us to the end of IAS10. So please pick it up again and try to understand it. So I have a diagram here for you. So that's the summary of IAS10. Okay, that's the summary of IAS10. So you can take a look at that. Okay, so let's go to the next standard before us. Okay, it's going to be IAS37. And if we have time, maybe I'll introduce IAS20. And next week, we need to look at borrowing costs. And then before we end, if you're able to take on IAS38, IAS40, and of course, IAS16, so I'll find a way to do all those 3 standards in a lecture. I'll just do a table for you to see the differences and how the examiner can pick you up on that. So let's take a look at provisions, contingent liabilities, and contingent assets. So as usual, let me go to the boardroom so that I can use that to explain the whole of IAS37. Okay, and just come back there to pick 1 or 2 questions that we can solve. Okay, all right. So it will be easier for me to really explain that concept around our standards so that you can understand rather than just looking at the notes, and it's more or less like reading it. Okay, so let's see. We have IAS37. Okay, IAS37. Provisions, contingent liabilities, and contingent assets. So we have 3 elements there. So let's take a look at it one by one. What is provision? Provision, okay, my brain, provision is a liability. So I was trying to tell my brain to bring the definition back to me, right? Provision is a liability of uncertain timing. Uncertain timing. Okay, or amount. Provision is a liability of uncertain timing or amount. Provision is a liability of uncertain timing or amount. Now, literally, what's the meaning of provision? Okay, when you try to provide for, okay, you try to provide for example, you want to go to the market, you want to buy stuffs, or and then you are now trying to list out what you want to buy. So you want to buy kulikuli, 5 naira. You want to buy, let's say, calculator, 10 naira. You want to buy exercise book, 15 naira, right? So because you know the prices, it's quite easier for you to allocate or to assign or to attribute those costs to those particular items. So at the end of the day, you now say, oh, in case the price moves up or down, or you see some items you cannot remember, and you need to buy, then you now do something like miscellaneous, right? That's like provision. You now say 20 naira. So that means if price moves up, okay, you can use part of that 20 naira, to add to it. Or if price moves down, you gain. Then if you see something that you didn't budget for, or you can't remember at the time you're making your budget, then you can also buy. So how do you buy it? That's out of your miscellaneous. So that's exactly what provision really is. But this is a problem in accounting, okay? This is a problem in accounting. In good years, be with me here, because if you can understand IAS37 now, you will have issues when it comes to corporate reporting. You still see it in corporate reporting, right? It's the same thing. Examiner will still pick you up. But at this level, what is going to be asking you is differentiate between provision and contingent liability. It's going to ask you that. It's always coming up every diet, okay? But then, before I go into that, let me quickly explain something here to say that, for companies, this is accounting issue now. For companies, in good years, okay, when they are making profit, when companies are making a whole lot of profit, they can decide to reduce that profit in good years and release it in bad years, okay? So how will they do that? They will do that by way of provisioning. They will make provision so that the profit for that year will be reduced, okay? And in future years, maybe when their performance is not as good as they expected, they now start releasing back those provisions. And how do they do that? They debit profit or loss and credit provision, all right? So the issue now, and that's what they call in accounting, that's what they call big bat accounting, all right? They call it big bat accounting. You can read more of that in your, maybe you can even Google it, okay? That's what they call big bat accounting. So it's just a way of, reducing your profits in a particular year and releasing it in another year, okay? So that's big bat. So now, entities use provision to manipulate accounts, just like IAS10 that we saw earlier. They use provisions to manipulate accounts, and that's why the standard was issued on IAS37, which is provisions, contingent liabilities, and contingent assets. So now say provision is a liability. So before you can even recognize provision, it has to be a liability. So you can't just go to the account and reduce your profit. But uncertain, I'm not sure. All right, so sometimes I'm not sure. That's why it's uncertain. I'm not sure of the timing. When am I going to pay? Or when am I going to discharge that liability? I'm not sure. And sometimes I'm not sure of the amounts. Did you see that? So it's a liability of uncertain timing. When will I pay? Or the amount. How much will it involve? Is it 20,000? Is it 100 million? Is it, you see? So I don't really know. Okay, so that makes it provision. So that's what you need to understand. IAS10 now says for you to now create provision what's it called? As an entity, okay, 3 conditions must be met. Okay, 3 conditions must be met. So let's take a look at that. Number 1, there must be present obligation. Sorry, there must be present obligation. There must be present obligation. Legal or constructive. Legal or what? Constructive as a result of past events, which is obligating event. Okay, which is obligating event. Okay, so that's the first condition. And right inside this class, you need to start putting it in your head. Okay, and most likely it might be a revision for some sort of people. Okay, that's really nice. I'm pretty sure you're going to see IAS37 in your exam. Then number 2, so anything I use my hand to write, hey, very important. Is in your notes. I have reasons for writing it so I can explain, right? Now, Number two, an outflow of resources embodying economic benefits, an outflow of resources, okay, embodying economic benefits. I won't write that one. Will be required, okay, to save time, will be required. An outflow of resources will be required, which is also fine, okay, to settle the obligation. Okay, so that means I need money. That's the meaning. That's what it's saying, right? Then number three, the amount of obligation, the amount or the cost of obligation can be measured reliably or with reliability. Reliably. Okay, so that's it. All the three conditions must be met at the reporting date before you can recognize provision. So let me now try to explain them one after the other. So here say there must be present obligation, legal or what? Constructive. Okay, there must be present obligation, legal or what? Or constructive as a result of past events, okay? As a result of past events, and that is obligating event. So what's the meaning of legal? As a result of contract, all right? That's legal. You have entered into a contract to pay certain amount of money, then you already have a present obligation. The constructive obligation is as a result of past pattern of practice of an entity, okay? What an entity has been doing. For example, let's say Samsung or Tamoku. Anytime you buy any electronics from them and take it to them, maybe because it has fault, and they do it for you for free, and that's what they've been doing to their customers. They have already created a constructive obligation because that's a past pattern of practice. That's the history. That's what they normally do. Okay? Then it has to be as a result of past event. So what does that mean? You cannot say, I want to make provision for a liability that I will incur. Okay? So let's say you are planning to go and buy phone on credit next week. That's the plan. You can't make provision now to say, oh, I'm going to buy a phone on credit next week, so let me make provision for it. No. So it has to be as a result of past events for a company. So that means it must have occurred, all right? So for future liability, you don't make provisions for them, right? So that's what I'm saying as a result of past events, obligating events. What does that mean? Obligating event will put an entity into a condition whereby they cannot avoid the obligation. Now listen, once an entity can avoid that obligation, they cannot make provision. Let me give you a classical example so that you understand. So let's say, for example, the Lagos state government, enact a law, okay, that all tuition houses in Lagos must install a robot into their tuition houses by December 2022, okay? They must install a robot so that when students are coming in, it's going to scan them and see whether they are virus free, for example. And the law says you must install by December 2022, okay? Now, and I'm preparing my account as of December 2021, and the law will take effect, or let's say by December 2022, they will start arresting or closing down tuition houses or companies that have refused to install that particular robots or artificial intelligence. So the question now is this: when I'm preparing my account as at December 2021, can I make provision for the costs of installing that particular robot? So that's the way I'm going to. Can I make provision? Before you can answer that question, you need to check whether there is a present present obligation. Yeah, we can say that is a present obligation. It's not as a result of the law. Did you see that? It's as a result of the law. So we can say, yeah, fine, okay. Is it as a result of past event? No, it is not as a result of past event. Do you know why? I don't have obligating event, even though it is the law, okay? But I can avoid that obligation. How can I avoid it? I can decide to close down my business before that time. I say I'm not doing it again. So that's it. So once I can avoid the obligation, then you can't make provision. But remember, all the three conditions must be met. So if you check that scenario I just gave you, you could see that an outflow of resources will be required. That condition was met, and the cost can be measured reliably. Of course, the cost of the robot would have been known, right? So two conditions was met. But the issue is there is no obligating event. I can my business before that time. So I'm not under obligation to install that particular artificial intelligence. So whenever the examiner gives this scenario, you need to check very well, especially that number one condition. Does the company has obligating event? If the answer is yes, then they can go ahead and measure and recognize provision. So please take note of that, all right? So that is the recognition criteria. So how do you now measure provision? How do you measure provision? Okay, measurement criteria. Provisions are measured at the best estimate. So let me do that. Measurement criteria. Provisions are measured at the best estimate of the expenditure required to settle the obligation. Okay, provisions are measured at the best estimate. You know, we said we are not sure of the amount, and neither we are sure of the timing. So you are going to measure them at the best estimate of the expenditure required to settle the obligation for a single item. A single item, you know, for a single item, for example, court case, you are going to look at the most likely amount payable, the most likely amount that is payable, okay? The most likely amount payable. That's for a single case or for a single item. But for a large population of items, for example, warranty provisioning, what do? For a large population of items, you look at the expected value, okay? Okay, so I'm going to demonstrate all of this to you or for you when we get to solving questions. So for a large population of items, you look at the expected value, okay? So any of this one, if it is material, you discount to present value. Remember, it's provision. We are going to spend it in the future, but you have to discount to present value. So if the examiner wants you to discount to present value, he will give you the cost of capital or the discounting factor, okay? For you to discount to present value. So all you need to remember is, how do you measure? When you say measurement, that is the value, okay? The three conditions has been met. Then how much will I now recognize? How much will I use to recognize provision? It has to be the best estimate of the expenditure required to settle the obligation. And for a single item, it will be the most likely amount payable. And for a large population of items, it will be the expected value. So that's what you need to understand. So let me quickly explain contingent liabilities and contingent assets. Okay, contingent liabilities and contingent assets. So let me quickly explain that. Contingent liabilities and contingent assets. Have you done screenshots? Can you screenshot this? Even I don't want to clean it. I think my handwriting is becoming finer. I think so. I'm waiting for you to do screenshot. Okay, so let me quickly explain contingent liabilities and contingent assets. Then we can now go to special application. Then we can now solve questions. Okay, now solve questions. Okay. Okay, so I think I can clean the board now. Okay, yeah, brilliant. Yeah, okay. So let's see, where's my pen? Okay, it's here. So let's see, we are still on IAS37. So let's do contingent liability. Oh, sorry. No, unfortunately, you can't even change individual item. Okay, sorry about that. Please. So we are on IAS37. Yeah. Contingent assets. No, we are starting with contingent liabilities. Okay, now, what is a contingent liability? Now, from the name, contingent, you're not sure. It's depending on something, right? So a contingent liability, I'm not going to write that, so just listen in your notes. Contingent liability is a possible liability whose occurrence be dependent on one or more uncertain future events, right? That means the liability crystallizing will be dependent on one or more uncertain future events which are not within the control of the entity. So that's what they call contingent liability. So say, for example, there was a court case. One of your customers sued you because you infringe on their patent rights, all right? So they sued you towards the end, but you don't know whether you are going to pay or not because it will depend on the outcome of the case, which will be the judge that will, prescribe or lord over that particular event or that particular issue. Okay, so that's a possible liability. Okay, that's a possible liability. It could also be financial guarantee. All right, if you give somebody a financial guarantee that if the person did not pay, come and pick me up, but you're not sure whether the person will not pay or not. So it's a contingent liability. It's not a liability yet. Liability is a present obligation. Is that okay? So that's the issue. So the issue now is this. What is the accounting treatment for a contingent liability? According to IAS37, you are going to check whether the contingent liability is remote. Okay. Number two, you will also check whether the contingent liability is possible. All right. Then you also check whether the contingent liability is probable. All right. Whether it is probable. Now, it is remote because there are less than 10% chance that it will crystallize. That means it is remote. So if it is remote, now the examiner will not necessarily tell you that it is remote. He just tell you that there are 90% chance that it will be successful. 90% chance that it will be successful. So that means it is remote. Okay. So in that case, what do? You ignore. You don't even do anything about it. Just throw it out. So that means it won't affect your account. All right. Now, if it is possible means 50-50. We can win, we can lose. All right. That is 50-50. In that case, what do? You disclose. All right. So disclosure is required. Disclosure. Okay. If it is possible, the examiner will also tell you that there are 50% chance that the company will lose or will win. Okay. So in that case, it will be disclosed in the account. But if it is probable, that means more than 90% that you're going to lose. That contingent liability will crystallize into a normal liability. That is probable. So in that case, you now need to disclose. Okay. You need to disclose and provide. All right. You need to disclose and provide by debiting profit or loss and crediting contingent liability. Is that okay? So that's what you do. So let's go to the other one, contingent assets. Okay, contingent assets. I think I can do that one here. Contingent assets. Contingent assets. Now, for a contingent asset, it is also a possible asset. Okay, whose occurrence will be dependent on one or more uncertain future events. Okay, It will be dependent on one or more uncertain future events. Okay. Okay. So that is a contingent asset. For example, you are the one that is now suing somebody to a law court. All right. So you are expecting money, you are expecting damages. That is a contingent asset because it will be dependent on one or more uncertain future events which are not within your control. Okay. So that's a possible asset. Then, if you have a contingent asset, you also check if it is remote. You also check if it is possible. Okay. Then you also check if it is what? Probable. You also call it virtually certain. All right. Also call it virtually certain that it will happen. Now, if a contingent asset is remote, what do? You ignore. All right. So you have to take note. If a contingent asset is possible, what do you also do? You also ignore. Then, if a contingent asset is probable, what do? You can what's it called? You can now disclose. Okay, you can disclose because a contingent asset you can't recognize it as an asset. It has to be a normal asset before you can recognize. So what you do is to disclose. Okay, except it's more than 90% chance or almost 100 that is going to crystallize into an asset. So that's how you can recognize as a normal asset. But this is what the standard is saying. So you could see that if you check what I've done, you see that remote for contingent liability, you ignore. You also ignore here. But when it comes to liability and it is possible, prudency require that you disclose immediately. Because this is an asset, you just ignore. So that's the difference. But once it is probable, you go ahead and disclose and make provision. But here, you make disclosure. So that's what you need to learn under that. Okay. Now, this is what the examiner is going to test. It will ask you, differentiate between contingent liabilities and provision. That's what you normally say. They ask you to differentiate. All you need to tell the examiner is the first part that I taught you. The provision is a liability of uncertain timing or amount. Then you tell the examiner the recognition criteria, and of course, measurement criteria. Okay. Okay. So that's it. So that's what you need to learn around that. So that's what you need to learn around that. Okay, so that's it. So let's now go to, let me quickly explain special applications. Then I can quickly go and pick up a question and solve. The examiner has never tested the special application at this level, but let me just explain in case he decides to test it this time. So this is what he has tested ever. Then I can also give you a scenario to identify if there is a contingent liability or a contingent asset. Okay, so but it has never tested special application. So let's see. So we want to look at special application. Okay, but remember, we are still taking on IAS37. So one is a future repairs to assets. Future repairs to assets. Okay. The other one is future operating losses. Okay. Yeah, I just said it should bring it. Future operating losses, they are somewhere in my memory. The other one is onerous contracts. In fact, onerous contracts was tested in corporate reporting last diet. Okay, but they've never tested at this level. Then you have environmental provisions. Okay, you have never tested it at this level. And or let me say I've never seen it, Sha. I've never. And I review past questions a lot. Then the last one is restructuring. Restructuring. Okay, that should be hard, right? Okay, provisions. All right, so these are the 5 special applications when it comes to provisions. All right. Do you have any question? Onerous contract. Oh, okay, so you're trying to remind me. Thank you. Yeah. All right, brilliant. Okay. So let's see. What's the meaning of future repairs to assets? It is in your company's policy that every 6 months you must repair all your air conditions or air conditioner or whatever. Okay, it's in your policy. Whether they are bad or not, they are still working well. You must repair them or you must service your official car every 6 months. Now the question is, at December 2021, for example, when you are preparing accounts, can you go ahead and make provision for that future repair or future maintenance you are going to carry out in June next year because it's in your policy? The answer is no. You cannot make provision for future repairs to assets. Do you know why? Number one, it relates to the future. There's no present obligation. And even another thing is, we said it must be a present obligation, legal or constructive, as a result of past event, obligating event. That means you cannot avoid the obligation. In this case, we can avoid that obligation by selling off those assets before June. So that's it. So that's it. So it relates to the future, and you can even avoid that obligation. So obviously, you cannot recognize provision. So once you see a scenario that is talking about you want to repair in the future, okay, then tell the examiner you can't provide. Then number two, future operating losses. You're already thinking that this is your particular business. This is your particular business. We make loss, okay. This business will make loss. Then that's future operating losses. Can I provide for that loss? The answer is absolutely no. Okay. You see, all these answers, you are not just thinking in your head. You are going to apply the principle in the standard. Okay. If you are thinking that your business will start making losses, it's an indication of impairment. That's one. Two, that loss relates to the future. Three, you can even avoid the loss by stopping the business before that time. So you can't make provision. Onerous contract. What is onerous contract? The unavoidable cost of fulfilling a contract exceed its economic benefit. All right. When the unavoidable cost of fulfilling a contract is higher than the economic benefit, then that contract is onerous. Okay, and it usually happens around lease arrangements. Just like COVID, where, for example, you have a warehouse, okay, and you're going to pay 500,000 for the rent, let's say for the next 2 or 3 years. Then COVID happened. There was lockdown, and you cannot do business again, and the rent is running. Unavoidable cost of fulfilling that contract. Can you see that? It's not higher than the economic benefit. The economic benefit you get is maybe when your container comes, they warehouse it, you can sell it, but because of COVID or whatever reason, you can't do that. Or because of Russia-Ukraine war, okay? So those are onerous contracts. But the question now is this, can I make provision? According to IAS37, the answer is yes, all right? So you are now going to measure it at the lower of cost of fulfilling the contracts, the cost of fulfilling the contracts, and the cost of terminating the contract with any penalty payments. Okay, terminating the contract and any penalty payment. So it's in your notes. So go and look at that. So you're going to do the present value because it's in the future. So you're going to do the present value. So the cost of fulfilling the contract and the cost of terminating the contract plus any penalty payment. So that will be the amount of provision you are going to do. Now, what's the meaning of environmental provision? Environmental provision is also what they know as clean up cost. Clean up cost. The cost you incur to clean up a particular damage that a company has created to the environment. It normally happens in oil company, extractive industries, even some chemical companies, some manufacturing that deals with chemical waste and all of that. So sometimes they create a lot of damages to the environment. So the question is, can they create provision? The answer is yes, provided they have created a constructive obligation. That's one. They have created a constructive obligation. That means anytime they create damage, they normally rectify it. So the society already knows them for that. So that means they have created a constructive obligation. Is that okay? And as a result of that, they can go ahead and create provision. And then if they want to create provision, they have to create provision for damage that's already been done, not future damage that will be done. Is that okay? It has to be damage that's already been done. So that's the environmental provision. Then restructuring. Can you make a provision? What's the meaning of restructuring? Maybe you try to change the scope of your business, introduce new products, you relocate your business, you eliminate layer of management. Nobody bothers about that. Nobody's going to test all of that. I'm just trying to let you know what restructuring really is, okay? Can you make provision? The answer is also yes, provided two conditions are met. Okay. In fact, at a corporate reporting level, I was expecting ICANN to bring on restructuring provision rather than onerous contracts. Because of COVID, a lot of companies restructure, right? So can they make provisions for that restructuring? So the answer is yes. Oh, okay. I think onerous contract was also fine because of COVID, most of the lease arrangements, unavoidable costs were higher than the economic benefits. I think that's also fine. Okay. So now, for restructuring provision, before you can make provision for your restructuring, two conditions must be met, okay? There must be a detailed formal plan, okay? There must be a detailed formal plan. What does that mean? Mere board meeting that they want to restructure is not sufficient to make provision. So there must be a detailed formal plan for the restructuring that identifies the business, the location, and the timing involved, including the costs that will be incurred. Okay, so everything is in your notes. So what it means is you just use this my analogy or my explanation to read those notes, so you can skip all the theory, the story areas. Okay, so that's it. So there must be a detailed formal plan, that for the restructuring that identifies the business, the location, and even the employee involved. So that means there must be a plan, for that restructuring. That's one. And number two, what's it called? There must be a valid expectation, okay, from the employee affected. So let me write it this way: the employee affected must have a valid expectation. The employee affected must have a valid expectation that the restructuring will be carried out. Okay, they must have a valid expectation that the restructuring will be carried out, either because it has started or it has been communicated to them. Okay, so that means the people that have been affected should have known, either because they have started the restructuring, because most likely restructuring will lead to redundancy. A lot of people will lose their jobs, right? So that's it. So when those two conditions are met at the reporting date, they can decide to create provision. And that is the end of IAS37. Then from there, we can take a look at one or two questions. So please, if you have questions at any time, put it up on the chat room. I'll be glad to answer your question. This special application, just have an idea, okay? I'm not really pretty sure the examiner brings you up on this. But if you decide to test IAS37, as he has been doing in the past, because this is FR, it's going to ask you, differentiate between provision and contingent liability, okay? You should be able to do that. In the next question, you cannot create a scenario and ask you to respond to that particular scenario. Or you can even ask you to compute how much provision will be recognized, okay? So you need to know that. They have idea about around this 5 in case you decide to bring it up for you. Okay, so let me go back to the slide and try to see whether we can lay our hands on one or two questions before we move away from IAS37. So you can see is everything we have explained. So go and take a look at that. Okay, and take a look at that. So this is what I was telling you earlier. Contingent liability, you ignore, you disclose and provide. So you can see it all up there. Okay, so let's look at this question. I think I should solve this question. Let me see whether I have it on my printed material here. Do I have it here? Oh, okay, we are on IAS37. Okay, let me see, so that I can go to the marker board and explain or work it out rather than just explaining from here. This one is on page 226 on my own printed material. 226. I just want to be sure. Okay, yeah, the question is here. Yeah, the question is here. Okay, let me see. Do I have another question here? Let me pick one of them. Let me see the one I can pick. Okay. You can go and practice all of this on your own. Okay, I think, okay, so let me do that very first question. Let me do the very first question. Yeah, because this will require you working out, what's it called? Working out, okay, what is the question now? Sorry. Okay. Makajoy is a public limited company. It's a leading support service company which focuses on building industry. The company would like an advice on how to treat certain items under IAS37. The company manufactures and sells building equipment on which it gives standard 1-year warranty to all customers. The company has extended the warranty. Sorry. 1 second, please. Okay, now, where am I? The company has extended the warranty to 2 years for certain customer. Okay, in order to save time, let me be interpreting it as I'm reading. So I'm under warranties now, right? It said the company manufactures and sells building equipment on which it gives standard 1-year warranty to all customers. So all customer that buys, it gives them 1-year warranty. Now, the company now said they have extended the warranty to 2 years for certain major customers. Did you see that? All customers are entitled to 1 year, but certain customers, major, are entitled to extended warranty, that means into the 2nd year, and has ensured the cost of the 2nd year of the warranty. The warranty has been extended at no cost to the customer. The claim under the extended warranty are made in the first instance against Makajoy, and Makajoy in turn makes a counterclaim against the insurance company. Past experience, okay, so this is where we really need to focus on, apart from the first information that the examiner has given us. Okay? So we need to focus on this. It says, past experience has shown that 80% of the building equipment will not be subject to a warranty claim in the first year. 15% will have minor defects, and 5% will require major repair. Makajoy estimates that in the 2nd year of warranty, 20% of the items sold will have minor defects and information there. Now said, assume the sale of equipment are on 31st October 20x7 and any warranty claim are made on 31st October in the year of the claim. Assume risk adjusted discount rate of 4%. Draft a report suitable for presentation to the directors of Makajoy, which shows the accounting treatment of the above warranty provision under IAS37. Okay, so here, what the examiner wants us to do is to calculate the provision that will be required for the warranty, all right? So he's asking us to calculate the provision. And we said provision are measured at the best estimate of the expenditure required to settle the obligation for a single item. You look at the most likely amount payable, but for a large population of items, you look at the expected value. So we are looking at the expected value here because this is what's it called, warranty. So I would like to go to the board marker to solve this question. Even if I can't solve any other question, this will demonstrate whatever. Remember, it's an intensive class, right? So this will demonstrate the most technical and difficult aspect of IAS37. It's not really difficult, okay, but then that question looks difficult. So let's try to do it, but you find out that it's actually very simple. But before I do that, let me give you a formula. Anytime you want to compute what's it called, provisions. Okay, I'm going to clean it, but let me quickly give you. So if you want to compute provisions, that's a figure. Okay, if you want to compute it, you look at you would have sold item, you would have sold some item. So you look at the sales that you have made, right? Sales or units that you have sold. So let me call it units, okay, that you have sold. You multiply it by the percentage of what you expected or what you expect that they will return. It's warranty, okay? So I'm trying to make provision. So the examiner will always give you that figure. So you can say 4% to be returned, you can say 10%, okay? So multiply it by the percentage. So if I have sold 2,000, so I'm expecting 20% to be returned. So multiply by that 20%. Then you now multiply by the cost. So that means if they return it, how much will I use to repair? Is that okay? That's exactly what we want to do. So if you can understand that, then you are good to go on this question. Is that okay? So look at the units sold, percentage of return, and the cost that I will have to incur if they eventually return. So the final figure you have is your provision. If the examiner wants you to discount it to present value, he's going to give you the discount factor, then you apply it on it. Is that okay? So let's quickly solve that question. Please, when you write it down or you screenshot, okay? So I can clean it up. All right. So going, gone. Sorry. Okay. So okay. I don't think I want to do that. So let me just marker join. Okay, marker. I'm not sure whether I got the spelling correctly. That's not an issue here. So we are on year 1, if you can remember, and year 1 talks about standard warranty. All right, standard warranty. Standard warranty. Okay, so we're going to look at the expected value. Expected value. Then we also look at discounted. I think they gave us 4% discount. Discounted expected value. Expected value. Okay, so let's take a look at that. I think we have a Naira sign. I'm not sure whether it's in 1,000 or in million, but let me just assume. Okay. Okay, so what do we do here? So let me go back to the question. Remember that one that I highlighted. So I want to read it from here. It says, past experience has shown that 80% of the building will not be subject to warranty in the first year. So what does that mean? So I will now say 80% of nil. Okay, 80% of nil. You see that? So it will give me 0. That's what it said. They say 80% of the building will not be subject to warranty. So that means they are not returning anything. It now says 15% will have minor defects. Did you see that? 15%. So I will now say 15% multiplied by what is the number of units that I sold. Can you see? So we sold if you look at the sales under that table, we have standard warranty, extended warranty. Have you seen it? Okay, so they said 2,000 units and 5,000 units. Abi, remember we're in year 1. That means we sold everything in year 1. So 7,000 units was sold. All right, 7,000 units. Then you say 15% we have minor defects. So if they return it, how much will I incur? That's my cost. So I'll now go to minor defects. They gave us 100 Naira for minor defects. Okay, so that's it. I already gave you the formula. So that's what you're doing. So I'll now say, I'll now press my calculator, 15% multiplied by 7,000, then multiplied by 100. So what will this one give us? It will give us 105,000. Okay. Okay. I'm not sure whether this should be in thousand. I think it should just be in naira. So let me try and take it out. Okay. I think it should just be in naira. And if it's in thousand, try and leave it like that. What matter is my figure here. Okay. So let's move on. Because of time. Then it now says, I'm just following what the question is saying. Okay. So it now says 5% will require major repair. 5%. So I'll now say 5% multiplied by 7,000 units, then multiply by. So how much is the major defect cost? It will cost 500 naira. Okay. So check the question. So be sure you are seeing 500. So I'll now say 0.05 multiply 7,000 multiply 500. So this will give me 175. Did you see that? Then I can add it up. 175,000, if I'm correct, plus 105,000. So this gives us 280,000. All right. Then multiply by, they gave us a discount factor of 4%. All right. So if you want to do your discount factor to be 1 plus R, I think I've taught you that under impairment. Okay. Raised power minus N. Okay. So basically, because we're in year 1, raised power minus 1. I'll now say multiply by 1.0 so that I can discount to, raised to power minus 1. I can discount to present value. So when I do that, that's discounted expected value. It will now give me 269,231. Okay. So I'll now go to, I didn't manage this well. So I'll now go to year 2. So let me try to manage it. Year 2 is the extended warranty. Extended warranty. Handwriting is so big there. Extended warranty. So let's find out what is happening here. So it says, Marker just estimate that in the second year of the warranty, 20% of the items sold will have minor defects. So it says 20%. So I'll say 20% multiplied by how many units were sold. Remember, all the customers are entitled to standard 1-year warranty, and they sold all the 7,000 items in the first year. But when I come to the second year, extended warranty, it is only a major customer. Okay, so if we check under extended warranty, we have 5,000 units. So you will not use 7,000. So it will be 5,000 units, because that will be the people alone that will be entitled to extended warranty. So we now say 20% of the items sold, we have minor defects. So the cost of minor defects is actually 100. Then we now say 10% will require major defects. So to be 10%, 5,000 units, all right, multiplied by 500. Okay, so that means effectively 70% will be new. Okay, 70% will be new. That's the meaning, because that's be 100%. Just like the way we had 80% new in the first place. So we now say 0.2 multiplied by 5,000 units multiplied by 100. So all this will give us, it's going to give us 100,000. Okay, then 0.1 multiplied by 5,000 multiplied by 500. So this will give us 250. Okay, so if I add it up, it's going to give us something around 350, if I'm correct. Okay, then multiply by 1.04 raised to power minus 2. Okay, so plus 100, then multiply by 1.04 raised to power minus 2. So it gives me something like 323,595. Okay, so I will now add it up. So we add it up, plus 269,231. So the total will be, is it 592,826? All right. So that's the total. So that's what the that's what that paper is saying. That's what the examiner wanted to do. Okay, so that's it. So you have the solution there. So I just tried to demonstrate it for you how it should be done. Then you have some other questions there as well that you can lay your hands on. Okay, so that's that. So that is IAS37, provisions, contingent liabilities, and then contingent assets. Okay, so let me go back to the slide and see. Okay, so how to do it in a report format. I've already done it for you. So did you see? We got the 592. Okay, so it was rounded up here to nearest 1,000. Can you see now? So we actually got the 592. So that's it. So that's it. So that's it. Thank you for joining. Okay, so that's it. So go and take a look at this other question and try to lay your hands on them. So I want to believe you are enjoying you are enjoying the flow, all right? I'm not really sure because you're not talking, you're not asking me questions. But let me have your feedback. I hope you are enjoying the flow. Okay, so the next thing on our agenda is IAS20, accounting for government grants and disclosure of government assistance. All right. So let me use the next 10 to 15 minutes. Let's see whether I can explain IAS20. So the next class we just sorry, the line will be stopped shortly. So we just solve questions like this. Okay. All right. Thank you for your feedback. Okay, you are wishing if cash flows can be taught like this. Oh, okay. All right. Okay, we see about that. Okay, the light is back. All right. Thank you for enjoying the class. Okay, so let me just explain IAS20. Okay, and let's see whether I can finish the next week when we meet. We'll quickly solve one question around it. I can quickly do IAS23 and what's it called? Then you can quickly now look at those three key standards: IAS36, IAS38, IAS40, and then IAS16. Okay. I need to go back to the boardroom. I need to go back to the boardroom. I need to go back there. Okay, so I can explain IAS20. So I'm going to stop in the next 15 minutes thereabout. So I can give space for people that want to take a PM class. So let's see, IAS20. So IAS20 deals with accounting for government grants and disclosure of government assistance. Now, nobody's going to ask you what is government grant, but they are assistance by the government in form of transfer of resources. Okay. The assistance by the government in form of transfer of resources in compliance for past or future conditions that an entity has complied with that are relating to the operating activity of that entity. But this is where I'm going to. Don't bother about that. Now, two things in that definition. One is transfer of resources. Okay. Transfer of what? Resources. So that's the first thing. So when government is transferring resources, it can be in two ways. They can either transfer money, all right? They can give an entity money, which is also called income to the what's it called? To the company. And this is what we call grant related to income. Grant related to income. Okay. So that's what we call grant related to income. Is that okay? So that's what you need to understand. So money, income, grant related to income. Then in an exam, the examiner can call it revenue grant. Did you see that? Revenue grant. So they can use any name for that. So when they give you money, to settle part of the expenses. Then you say that's grant related to income. Then the company or the government can also give you money or assets, right? That means they can give you money to buy assets. Remember, the first money they are giving you is to offset your expenses. So they are two different things. Is that okay? They give you money to offset part of the expenses. But in the second scenario, they either give you money to buy capital equipment or assets, or they give you the asset itself. So if they give you money to buy the asset, that one is straightforward. But if they give you the asset, for you to know the value, you look at the fair value. Is that okay? So they can give you money to buy assets. Okay. So if they do that, that is what we call grants related to assets. All right. So we call that grant related to assets. The examiner may want to shock you and say, explain what is meant by capital grant. So you don't run away. Hey, they didn't teach us. So capital grant is also known as grant related to assets. All right. Now, when the government is doing this, they don't do it for free. There is always a condition. Okay. There is always what? A condition. Sorry, that's C. So there's always a condition attached to the grant. So it is not always for free. Okay. So even if the examiner has not said IAS20 precisely, and he said maybe a government agency, decide to give a company some money, all right, if they do certain things, all right, so that is a condition. So condition is always attached, all right. For example, the government can say employ fresh graduates, all right, that's a condition. Employ fresh graduates. So that could be a condition. So if it says employ fresh graduate, what does that mean? So if you say employ fresh graduate, you can say if you employ, we're going to give you 600,000 and their salary is 1 million naira, maybe in a month or in a year. Okay. So that means the money they are bringing in, 600,000, we relieve you of that 1 million you are paying. That means effectively you are paying 400,000. Is that okay? So that could be a condition. Another one could be set up your business. Set up your business. You can say set up your business in a rural area. Okay, in a rural area. Nobody wants to go to a rural area, so government can attract businesses. Set up your business in a rural area. If you do that, I'm going to give you assets. Okay. Sometimes you can even say they will give you tax free. You won't pay tax for the next 3 years. All right. So those are government grants. So once it is government grants, then IAS20 will apply. Oh God, I hope you are getting it right. Sorry, I love drawing. To demonstrate, to break down the backbone of accounting standards, right? Don't mind me, I joke a lot too. So it's just for you to understand. So all the things you are seeing in ICANN Park, in any notes, whatever, this is everything they are saying. They are just saying stories, right? So that's why you have to be in class to make life easier for you. So now, that's what you need to learn at that level. Then let me now go to the recognition criteria. And let me see whether I can explain the measurements so that next week we'll just apply that measurement on a question. Is that okay? So that you can start living with the measurement. So let's see. So let me manage here. Measurement. No, sorry. Recognition. Before you can recognize, that's recognition now. Recognition criteria. Before you can recognize government grants, basically 2 conditions has to be met. 1, there must be reasonable assurance that the grant will be received. All right, grant will be received. So there must be reasonable assurance that the grant will be received. And 2, there must also be reasonable assurance that the conditions attached to the grant will be met. Attached to the grant will be met. All right. So that's the 2 conditions that has to be met before you can recognize government grants. Is that okay? The examiner may not even bother you around that. But that's it. So let me now go to measurement, then we can call it a day. So we have screenshot. I need to clean the board. Yeah, screenshot. Sorry, I played too much. Okay. So let me explain the accounting treatment. So let's find out. So remember, we are still under IAS20. Yes. So let's take a look at accounting treatment, or you also call it measurement basis. Okay. Accounting treatment. All right. Now, we said we have two types of grants. Can you remember? Number one is a grant related to income, if you can remember. Grant related to income. So what is the accounting treatment for grant related to income? So let's find out. According to IAS20, IAS20 allows two methods of accounting. So let's take a look. Method one, okay, is saying treat it as part of other income. Okay, treat it as part of other income. So what does that mean? So when the government grant is coming, for example, say employ fresh graduates. Is that okay? So when the grant is coming, let's say the total expenses is 1 million and is giving a grant of 600,000. They take it as part of other income. You call it government grants. They recognize the 600,000. Is that okay? So it will reduce whatever expenses you have paid. So you take it as part of other income. So that one is quite straightforward. Then method two, and that's what they also call income approach. Okay. Then method two, instead of recognizing the grant in your account or setting it up or treating it as a part of other income, you can do something like deduct the grant from related expense, right? Deduct the grant from related expense and recognize the balance, or debit the balance and recognize the balance and recognize the balance in the income statement or in the profit or loss account in the income statement. Okay, so that is what method two is saying. So what is that saying? If the expenses is 1 million, for example, so now deduct the grant from the related expense, 600,000. Then I recognize the balance, 400,000 in your income statement. So what does that mean? You will not show that government grant as a line item in your account, unlike method one. Method one is saying treat as part of the other income. That means you say government grants in your account. But here, you would have deducted it from the source. You will not show it in your account at all. You'll just be showing the net amount in your account. But that seems to contradict IAS1, okay? Because IAS1 is saying you cannot net off, except the amount is immaterial. That means you must show every transaction, on the account. But IAS20 allows it. And whatever the standard allow, it will prevail over the conceptual framework, okay? So that's the issue. So I don't want to go into much detail because this is an intensive class. Then, so let's now go to the type of government grant, number two, which is a grant related to assets, right? Grant related to assets. I hope you are getting my gist. I'm not sure because I can't see your face. If I'm in the physical class, I would have seen their faces, whether they are squeezing face or whatever, so that I can repeat, I can explain. But I hope and I believe you are really getting it, okay? So you need to put these things in your head. So that's why I'm taking the pain, to write it out. It's not really easy, okay? Okay, so let's look at method one, okay? So here, if it is grant related to assets, all you need to do is to set up a deferred income, all right? Set up a deferred income. set up a deferred income and spread over the life of the asset. Spread over the life of the asset. Okay, spread over the life of the asset. That's method one. So I'm going to give you an example here so that you understand better. Okay. So let's see. So you set up a deferred income and spread over the life of the asset. What does that mean? When the grant is coming, okay, you don't recognize it in your account in one accounting year. So if the asset that you are using the money to buy, we use 5 years. So why will you not recognize the grant in the account in one accounting year? So what it's saying is, as the grant is coming, set up a deferred income. Defer means you delay the recognition of the income. So as you are depreciating the asset, you'll be releasing the income. So let me give an example so that you understand. So let's say the cost of the asset is 5 million, for example, and the grant is 3 million. Okay, so the useful life of the asset is let me say what could I say here? The useful life of the asset is making a figure I can use. Okay, let me call this one so that I don't want to be getting points. So this is 6 million, and let me call this one 4 million. Is that okay? So the useful life is 2 years. All right. So let me just say this. Okay. So what does that mean? If I want to depreciate this asset, if I want to depreciate this asset, I would have said 6 divided by 2. Is that okay? Then I have 3. Is that okay? So each year I will recognize a depreciation of 3 million. Is that okay? Then each year I will also do the same thing with the grant. I will divide by 2 so that each year I release 2 million as income into my income statement. So as I'm releasing depreciation, I'm also releasing the income. So that's why I said set up a deferred income and spread over the life of the asset. So that's what method 1 is saying. I have spent 15 minutes. Okay, so we need to stop. But before we stop, let's look at the last one, which is method 2. So what is method 2 saying? Method 2 is saying deduct the grant from the cost of the assets. Deduct the grant from the cost of the assets and spread over the life of the assets. Okay, and spread over the life of the assets. Okay, so what does that mean? So instead of using method 1 where I release the income and depreciation, so here I will now say 4 minus 6, it will give me 2, Abi. So this 2 I will now divide by 2 so that I can have 1. So I'll now be releasing the 1, as my depreciation. Remember in the first example, I have 3 as my depreciation, Abi. Then I have 1 as my government grant, which is the income. Abi, was it 1? No, sorry, 2. If you say 4 divided by 2, so we have 2. So effectively on the account, the effect will be 1 in the first method. The same thing with the second method. I will deduct this 4 from this 6 so that I can have 2. Then I will now divide by the 2 years so that I can have 1. Did you see? You get the same answer. The only thing is one is showing the source of the grant. The other one is not showing because already deducted. And if I were you, if I'm reading, okay, you could see that there is similarity between this method 1 and this method 1. This one says treat as part of other income. This one says set up a deferred income. This one says deduct the grant from the related expense. This one says deduct the grant from the cost of the asset. Did you see? So that's how to master, that's how to study. Thank you for being with me. So next week, I'll just start straight up with a question to demonstrate IAS20. Then we'll move away from there, probably look at borrowing costs before we went to go to look at some other key standards. All right. So thank you for staying tuned. There's no question for me. Please explain deferred income. Don't worry. don't worry, I'm going to explain better with a question. But when you say deferred income, you don't recognize it now, everything now, you delay it. Is that okay? That's what they call deferred income. Is that okay? So you are recognizing it systematically every year, So that's it. So, but don't worry, you get it when I do a standard question in our next meeting. I sincerely appreciate your time, all right? You're going to get the video tomorrow morning, so you can watch it again. So, okay. So thank you so much. Have a wonderful night rest. My host, I appreciate you. Thank you so very much. Have a good night rest. Thank you. Bye-bye.